California has always sold itself as the land of endless opportunity. From the tech-fueled towers of Silicon Valley to the sun-soaked neighborhoods of Los Angeles, real estate here has symbolized wealth, stability, and the ultimate American dream. For decades, owning a home in California wasn't just an investment, it was a statement. Prices climbed year after year, fueled by global demand, investor money, and a population willing to pay a premium for the lifestyle only the Golden State could offer. But in 2025, that illusion of invincibility is starting to crack. Across California, homes that once sparked bidding wars now linger unsold. Prices have dipped month after month, inventories are swelling, and entire neighborhoods are watching property values tumble. Families who stretched themselves thin to buy at the peak are realizing they may now be underwater on their mortgages. Realtors, once overwhelmed with offers, complain of open houses that sit empty. Even seasoned investors are quietly pulling back, worried that the market that once seemed untouchable may be heading for a hard landing. The panic isn't confined to one city. It's spreading across the state. From San Francisco to San Diego, Sacramento to Stockton, the once booming housing market is in freefall. 10 cities in particular have become ground zero for California's real estate crash, each with its own story of rapid rise and painful decline. The question now is unavoidable. Are we witnessing a temporary correction, or is California's housing dream finally unraveling into a full-blown crisis? The boom that set the stage. To understand California's crash in 2025, we have to rewind to the boom years that set it all in motion. Between 2015 and 2022, the state's housing market wasn't just strong, it was on fire. Tech salaries, foreign investors, and historically low interest rates combined to push prices higher every single year. In cities like San Francisco, Los Angeles, and San Jose, the median home price doubled in less than a decade. The pandemic only poured gasoline on the fire. With remote work exploding, families left cramped apartments in New York and Chicago for California's promise of space, sun, and opportunity. Investors joined the frenzy too, snapping up single-family homes and condos, often paying cash above asking price. Bidding wars became the norm, supply vanished overnight, and sellers held all the power. For a moment, it seemed like California's housing boom was limitless. Why the crash? Began by late 2023, the cracks beneath California's glittering real estate surface began to show. The Federal Reserve's aggressive rate hikes sent 30-year mortgage rates soaring near 7%, instantly shrinking the pool of qualified buyers. Families who could once borrow freely suddenly found themselves priced out, while sellers clung to unrealistic listing prices. At the same time, California's economy hit turbulence. Tech layoffs rippled through Silicon Valley, weakening demand in San Francisco, San Jose, and beyond. Insurance premiums skyrocketed in wildfire-prone areas, making ownership unaffordable even for those who managed to secure a mortgage. Meanwhile, a steady outflow of residents, fleeing high taxes, rising costs, and worsening affordability, left entire markets oversupplied. Investors noticed. Hedge funds and corporate landlords that once drove the boom quietly pulled back. With fewer buyers, higher costs, and growing uncertainty, the foundation of California's once bulletproof housing market began to crumble. Now let's move to these 10 cities. 1. San Francisco. San Francisco has always been California's most notorious real estate market. Sky-high prices, fierce competition, and homes that sold for millions despite crumbling foundations. But in 2025, the tech capital is now the epicenter of the downturn. The wave of tech layoffs from 2022 onward shattered buyer confidence. Meta, Google, and dozens of startups cut tens of thousands of jobs, leaving demand for high-end condos and luxury homes in free fall. Median prices have dropped nearly 9% year over year, and properties that once sparked bidding wars now linger unsold for months. Downtown is facing a ghost town effect. With remote work permanently reshaping office culture, entire blocks of commercial buildings sit half-empty, spilling over into the residential market. Investors who once banked on San Francisco as a can't-miss opportunity are retreating. Even longtime residents admit the shine has worn off, as crime concerns, homelessness, and affordability challenges compound the real estate slump. The city that once symbolized untouchable growth is now struggling to rediscover its footing. 2. Oakland. Just across the bay, Oakland's story mirrors San Francisco's collapse, but carries its own set of challenges. For years, Oakland benefited from spillover demand. Buyers priced out of San Francisco flocked here, driving up home values at record speed. By 2021, median prices had soared above $900,000, a staggering leap for a city once considered affordable. But now, as San Francisco's market cools, Oakland is feeling the aftershock. Buyers have vanished, leaving a glut of unsold homes. Sellers are slashing prices, with reductions of $50,000 to $100,000 becoming common. Rising crime rates and public safety concerns have accelerated outmigration, with many families relocating to suburbs in Contra Costa or even leaving California altogether. Meanwhile, investors who once snapped up Oakland duplexes and single-family rentals are scaling back, wary of falling values and political uncertainty over rent control measures. For Oakland, the dream of becoming the Bay Area's affordable alternative has unraveled, leaving behind a market in retreat. 3. San Jose. As the heart of Silicon Valley, San Jose rode the tech wave higher than almost any other city in California. At the peak, the median home price crossed $1.4 million, making it one of the most expensive housing markets in the nation. Fueled by stock options, tech salaries, and global investor money, demand once seemed insatiable. But by 2025, San Jose's fortunes are deeply tied to the tech industry's slowdown. Layoffs across major firms have left potential buyers hesitant. Startup founders, once flush with venture capital, are now scaling back, and luxury homes in neighborhoods like Willow Glen and Almaden Valley sit idle. Year over year, prices are down nearly 8%, with inventory swelling as more sellers test a cooling market. Renters are feeling the squeeze too, as landlords raise rents to offset losses, even while property values drop. San Jose, once the poster child of unstoppable growth, now finds itself grappling with whether its housing boom was ever sustainable. 4. Los Angeles. Los Angeles has always been California's real estate juggernaut, a city where international investors, Hollywood elites, and middle-class dreamers all compete for a slice of the market. But in 2025, LA is showing cracks that no one can ignore. The luxury sector, once fueled by overseas buyers and entertainment money, has slowed dramatically. Mega mansions in Beverly Hills and Bel Air that used to attract bidding wars now sit idle, some with price cuts exceeding $5 million. Developers who gambled on ultra-luxury projects are scrambling to unload them. At the same time, the broader housing market is straining under affordability pressures. With mortgage rates hovering near 7%, the average Angelino simply can't afford LA's $900,000 median home price. Rental demand remains strong, but even there, the squeeze is evident as more households double up or leave the city entirely. Population outflows, particularly middle-class families heading to Texas, Arizona, or Nevada, are accelerating. This flight undercuts local demand, putting additional downward pressure on sales. The image of Los Angeles real estate as a forever hot market is fading. Investors who once saw LA as a safe global haven are pausing, and with rising homelessness and worsening affordability, the city is being forced to confront whether its market fundamentals were ever sustainable. 5. Sacramento. California's capital city was one of the biggest winners of the pandemic housing boom. Remote workers from the Bay Area flooded Sacramento between 2020 and 2022, driving up prices nearly 40% in just 2 years. Families traded cramped apartments in San Francisco for sprawling suburban homes in Sacramento, betting on remote work's permanence. But by 2025, that wave has crashed. Sacramento's median home price has fallen nearly 7% year over year as demand cools. Many of the pandemic-era buyers are now underwater, owing more on their mortgages than their homes are worth. Inventory has surged, particularly in newer suburban developments where flippers and investors overextended themselves. Mortgage delinquencies are creeping up as households struggle with high interest rates and inflation's bite. Unlike the Bay Area, Sacramento doesn't have a deep pool of high-paying tech jobs to stabilize the market. Once remote workers left or returned to offices in San Jose and San Francisco, demand collapsed. The capital's housing market, which thrived on being the affordable alternative, is now exposed as highly vulnerable to market swings. Sellers are chasing falling prices, and buyers are sitting on the sidelines. Sacramento's pandemic-fueled boom has become a cautionary tale. 6. Fresno. Fresno, long considered the affordable heart of California's Central Valley, also saw an unprecedented surge during the pandemic. Low interest rates and the promise of more space lured buyers from coastal cities, pushing the median price above $400,000, a record for a region where incomes lag behind the state average. But in 2025, the slowdown is hitting Fresno hard, exposing the fragility of its market. Many households in Fresno are already stretched thin by inflation and stagnant wages. With mortgage rates near 7%, affordability has collapsed, pushing potential buyers out of the market. Sellers, meanwhile, are flooding listings, leading to a growing oversupply. Homes that sold in days during 2021 now sit for months, often requiring steep discounts to move. Investors who bet on Fresno's rental market are also pulling back, worried about tenant defaults and declining property values. What makes Fresno particularly vulnerable is its economic base. Unlike Silicon Valley or LA, Fresno doesn't have the high-paying industries to support inflated home prices. As the economy tightens, households are prioritizing essentials over stretching into ownership. The result is a market correction sharper than anyone expected, with signs pointing toward further declines. Fresno, once marketed as California's affordable housing refuge, is now confronting a painful reset. 7. Riverside and the wider Inland Empire were pandemic darlings of California real estate. As buyers fled Los Angeles in search of more space and lower prices, Riverside became a hotspot, with bidding wars pushing home values up more than 35% in just 3 years. But what goes up fast often comes down faster, and 2025 has exposed Riverside's vulnerabilities. The city's median home price is now falling at one of the steepest rates in the state, down roughly 8% year over year. Much of this is tied to its commuter identity. Many residents work in Los Angeles or Orange County, and with high gas prices and long commutes, the appeal of Riverside has waned. Mortgage delinquencies are also climbing, particularly among first-time buyers who stretched beyond their means during the frenzy. Adding to the stress is Riverside's large inventory of new construction. Builders rush to meet demand, but today, many of those homes sit unsold, forcing developers to slash prices. Investors who once fueled the single-family rental boom are pulling out as vacancies climb. Riverside's once explosive growth has turned into a sharp correction, showing how dependent the city was on external demand. 8. San Diego, long known for its steady housing market anchored by military jobs and biotech, is not immune to the 2025 downturn. For years, the city's limited land supply and coastal allure kept it insulated from the volatility seen elsewhere. But now, cracks are forming. The median home price, hovering around $850,000, has begun slipping, a nearly 6% year-over-year decline. Affordability is the central issue. With mortgage rates above 7%, even high-income professionals are hesitating to buy. Coastal homes that once saw endless competition are languishing, and sellers are offering concessions rarely seen in San Diego's market. Meanwhile, rental demand has softened as younger residents flee to more affordable states. Military families and biotech workers do provide some stability, but San Diego's high cost of living is eroding its competitive edge. Insurance costs tied to wildfire risks in surrounding counties are further discouraging buyers. For the first time in decades, San Diego's real estate isn't seen as a can't-lose investment. Instead, the city faces the reality of falling demand and stubbornly high prices colliding head-on. 9. Stockton has always been one of California's most volatile real estate markets, and the current downturn is proving no different. Known for its dramatic boom and bust cycles, Stockton's housing market soared nearly 50% during the pandemic, as Bay Area transplants sought cheaper alternatives. But by 2025, the city is experiencing one of the sharpest corrections in the state. Median prices have dropped close to 10% year over year, with foreclosures and short sales making a return to the market. Stockton has a history of foreclosures, It was one of the epicenters of the 2008 housing crash, and signs are pointing toward a repeat pattern. Many pandemic-era buyers are now underwater, trapped by high mortgage payments and shrinking home values. Economic challenges amplify the problem. Stockton's job market doesn't have the stability of tech-driven cities, and its higher crime rates make it less attractive to new buyers. Investors who once poured into Stockton's rental market are retreating, leading to a surge in listings. For residents, it feels like déjà vu. Stockton's market, once red-hot, is sliding rapidly, raising fears of another foreclosure crisis. 10. Bakersfield. Bakersfield, the oil capital of California, experienced a surprising pandemic. Housing surged as families priced out of Los Angeles looked inland. Home prices climbed nearly 30% between 2020 and 2022, fueled by cheap credit and a rush of buyers seeking affordability. But by 2025, Bakersfield's housing momentum has stalled, and the city is now grappling with one of the state's harshest corrections. Median home prices are down about 9% year over year, and affordability remains out of reach for many locals. Bakersfield's economy, heavily tied to agriculture and oil, offers wages that lag far behind coastal cities, making the inflated housing prices unsustainable. Mortgage delinquencies are on the rise, particularly among working-class families hit hard by inflation and rising living costs. New construction has also flooded the market, leaving developers with unsold inventory. Rental investors, once bullish on Bakersfield, are exiting as vacancy rates tick up. The city, once seen as California's affordable refuge, is now feeling the sting of overextension. For Bakersfield residents, the dream of homeownership has once again collided with economic reality. What comes next for California real estate? California's housing downturn in 2025 has left buyers, sellers, and investors asking the same pressing question: what happens next? The answer isn't simple because the state's market is shaped by a unique combination of national economic forces, local policies, and demographic shifts. But one thing is clear: California real estate is entering a new chapter, one very different from the boom years of the past decade. First, affordability will remain the defining challenge. With mortgage rates hovering around 7% and home prices still historically high, many potential buyers are locked out of the market. Unless interest rates fall significantly, something tied closely to Federal Reserve policy, a large pool of Californians will remain renters by necessity. That sustained demand could stabilize the rental market, but it also risks deepening the affordability crisis that already dominates the state. Second, inventory pressures will shape the recovery. Many sellers are holding onto low-interest mortgages from the boom years, reluctant to list their homes and trade up. This so-called rate lock effect will keep supply constrained, even as demand weakens. The result is a market stuck in limbo. Not enough buyers to drive prices higher, but not enough sellers to cause a dramatic collapse either. Instead, slow declines and extended stagnation could become the norm. Third, geographic shifts will continue to reshape California's housing landscape. Cities like San Francisco and Los Angeles are losing middle-class families to states with lower costs and fewer taxes, while inland areas like Fresno, Stockton, and Bakersfield will face the toughest corrections due to weaker local economies. Meanwhile, coastal markets like San Diego may stabilize sooner thanks to diversified industries like biotech and military spending. Finally, investors and policymakers will play a critical role. Institutional buyers, who helped fuel the boom by snapping up homes as rentals, are now cautious, but they may return if prices fall further. On the policy side, California lawmakers face pressure to address housing shortages, homelessness, and the insurance crisis that is pushing up ownership costs. How the state responds, through zoning reform, rental protections, or tax incentives, could determine whether the market stabilizes or continues to unravel. In short, California's housing market isn't heading for a total collapse, but the era of relentless appreciation is over, at least for now. The coming years are likely to be defined by uneven recovery, slower growth, and painful adjustments in cities hit hardest by the crash. For buyers, it could mean opportunity on the horizon. For sellers, it's a reminder that the golden age of California real estate has passed, and the new reality has arrived. Lessons from the crash. California's 2025 housing crash isn't just about falling numbers on a chart. It's a story about people, decisions, and the risks that come with chasing an overheated market. For years, the Golden State's real estate scene seemed unstoppable, a world where bidding wars, skyrocketing prices, and endless demand convinced buyers and investors that homes would only ever go up in value. But history has a way of reminding us that no market is immune, and California's latest downturn proves that even the strongest housing economies can stumble. What's happening across cities like San Francisco, Los Angeles, and San Diego isn't just a correction, it's a recalibration of expectations. The days of double-digit annual growth are gone, replaced by a more sobering reality where affordability, interest rates, and demographic shifts drive the conversation. Inland cities such as Stockton, Fresno, and Bakersfield show us what happens when local wages fail to keep pace with inflated housing values. Meanwhile, Sacramento and Riverside are painful examples of what occurs when pandemic-era migration fades and demand evaporates just as quickly as it arrived. But there's also a larger lesson here. Housing markets are reflections of broader economic and social forces. Mortgage rates, tech layoffs, insurance costs, and even migration trends all intersect to shape the fortunes of California real estate. When those forces shift at the same time, the impact can be dramatic. And while the crash is painful in the short term, it could also bring long-term benefits. Stalled prices may finally open the door for first-time buyers who have been shut out for years, creating opportunities where there was once only frustration. Still, the road ahead won't be easy. Policymakers must grapple with affordability crises, rising homelessness, and an exodus of middle-class families who no longer see California as a viable place to build their future. Investors will need to rethink their strategies, focusing less on speculation and more on sustainable long-term growth. And ordinary buyers and sellers must learn to navigate a market that no longer guarantees quick profits or easy exits. California has faced housing downturns before, from the crash of the early 90s to the devastation of 2008. Each time, the state's real estate eventually recovered, but never without change. Markets shifted, rules evolved, and communities learned hard lessons along the way. The same will be true in 2025 and beyond. The state's housing sector will survive, but it will look different. The winners will be those who adapt, whether that means buying strategically during the downturn, renting until conditions improve, or rethinking what home means in a shifting landscape. So, as California writes its next chapter in the history of housing, one truth stands out. The myth of the endlessly rising market is gone. The crash of 2025 proves that even in the Golden State, reality always catches up. The question isn't whether California will recover, it will. The real question is, what kind of housing future do Californians want to build once the dust settles?